Welcome to News You Can Use in Your Personal and Professional Lives, a production of the Finn Financial Group, all rights reserved. I'm your host, Dan Finn. I am a 20-year-plus veteran of the structured settlements industry, and my firm exists to help clients achieve maximum financial security through the effective use of structured settlements and related products and services. I want to thank you for giving me the opportunity to be of service to you today. Today's session is entitled Taxable Damages, Mitigating Your Tax Liability with a Structured Settlement. We designed this exclusively for our valued clients across the United States, and as you watch, please bear in mind the original air date of July 17, 2012, because tax laws and interest rates are always subject to change. We're going to start today's session with a rather bold assertion that I'm going to make, and then I'm going to proceed through the rationale that will support that assertion and end with a case study that will hopefully illustrate exactly why we feel so passionate about this particular topic. And here's my bold assertion, something I feel very, very passionate about. While structuring a settlement for a personal physical injury claim is often a very good idea, failure to structure a personal non-physical injury claim usually results in the plaintiff paying more income taxes than necessary. And I struggled with the word usually here because I really felt like saying almost always. The analysis that we've done many times will show that the people who take cash settlements almost always pay more taxes than they have to if they would structure it. If you are okay with that, or you don't mind paying more taxes than you have to, then you probably don't need to go much further on this. But if you are like many of us and you prefer to pay no more taxes than you have to, and you subscribe to the old Morgan Stanley adage that we understand we have to pay taxes, but we don't want to pay any more than we have to, I think you'll find your time well spent here, and you will get quite a bit out of this session. Before your two pie charts, on the left is a representation of an individual who receives income in a year's time. Let's just say that circle or that pie is all the income that's received. The light blue portion of the pie is the amount of money that is earned that is kept by the individual, and the dark blue slice is what goes out in taxes. On the right hand side is representative of what happens after you achieve a taxable settlement. Notice that the pie, the entire pie itself is larger to begin with. It's a larger diameter pie. Not only that, but the chunk, the percentage that is paid in taxes is also larger. We believe that we can show you that you can have it both ways. You can have an after-taxable settlement that increases the size of your pie, but also reduces the slice of the pie that you have to give away in taxes. But let's start with the tax authority for injury compensation. First off, gross income is defined in Section 61A of the Internal Revenue Code, whereby it says gross income means pretty much everything, and then gives you some exclusions of some things that are not considered gross income. In other words, we're going to tax you on it unless we give you some kind of a break. Injury compensation specifically is discussed under Section 104 of the Code. 104A1 has to do with workers' compensation payments, and Section 104A2 has to do with pretty much everything else. 104A2 is your homeowner's claims, your car accident, your medical malpractice claims. Anytime there's a physical injury, a personal physical injury, and damages are paid and they're tax-free, it's because of the way 104A2 describes it. There are three other sections of 104A, 3, 4, and 5 that are beyond the scope of this presentation. So in summary, if it's not excluded, it's gross income. And as we all know, gross income is taxable. If you remember from the preceding slide, there was a the word physical was listed in 104A2. That word is going to be key to determine what is and what is not subject to tax. There's been a number of pieces of legislation that have come about over the years that have impacted the personal injury settlement process, but the one I want to focus on today is the Small Business Job Protection Act of 1996. There was a Supreme Court case, Commissioner v. Schleier, in which the Supreme Court ruled the petitioner was not entitled to tax exemption under 104A2 for a claim he made on account of age discrimination. This was very significant because it focused on the emotional distress component that prior to this point in time had been somewhat of a gray area. Whereas emotional distress that flows from say an automobile accident is one thing, it's quite another if the only basis for the complaint is emotional distress. And a lot of attorneys who file complaints should probably be aware of this distinction if they're not already. What they didn't do was define what a physical injury was. They only said that emotional distress alone was not a physical injury. So the good thing about this, from the perspective of the practitioners and for the structured settlements industry, it did create a need for expanded use of taxable structured settlement options, and we're going to talk about its impact here today. So we know that physical injury claims are exempt from taxation and non-physical injury claims are not exempt. You have to pay taxes on non-physical. What are some examples? If you remember in 104A2, they said punitive damages specifically were something you had to pay taxes on. But employment disputes, civil rights violations, any number of complaints that are made that don't involve physical injury, a lot of times emotional distress, but don't have a physical injury, are taxable. The lines aren't always as clear-cut as we would hope, however. Keep in mind bullying. It's one thing if someone pushes another down the stairs and they break their arm. It's quite another if they post something on a Facebook page that is objectionable. A lot of these can fall into an area where they overlap. Sometimes there is physical component to it and sometimes not. In those situations, it's wise to make an allocation between the physical and non-physical so the appropriate taxes are paid on the appropriate portion of the claim that's filed. I could spend 20 minutes on the non-qualified assignment process, but briefly I just want to say that it's very similar to the qualified assignment process that's used for the personal physical injury claims under 104A2. This is governed by Section 130 of the tax code, but pretty much the process is the same. The defendant and plaintiff agree to terms, which include future periodic payments. The defendant then assigns their obligation to make those payments to an independent third-party assignee and sends them the money, which they will then use to purchase an annuity from a life insurance company, who then makes the payment to the plaintiff as the defendant originally agreed. This allows the tax deferral to be accomplished, as we'll see here in a minute. Also, we sometimes see reinsurance used instead of the non-qualified assignment process. Both of them accomplish the same presumed tax deferral, but we're talking today about the non-qualified assignment process. This helps you overcome receipt of income. We know that we only pay taxes when we receive income, but a lot of people don't give much thought to constructive receipt. There are some times where you need to pay taxes on money that you have not yet received if you could have received it. There is a Treasury regulation, subchapter A, section 1451-2A, tells you when constructive receipt is avoided. And it's by structuring in this non-qualified assignment process that we help create the substantial limitation that is necessary to accomplish the tax deferral. In 2008, there was a private letter ruling that looked at a non-qualified assignment case, and they gave it its blessing for tax deferral. This opinion held that there was no actual receipt, no cash equivalency, no constructive receipt, and no economic benefit by structuring the settlement the way they did. All of these are important hurdles that need to be overcome in order to accomplish tax deferral. Best of all, its summary said unequivocally that taxes payable were only payable in the year that the income was actually received. And although private letter rulings can't be cited as precedent, they are often very helpful in planning for individuals who are going into similar situations. Did you ever notice how sometimes taxes seem to appear out of nowhere and they just creep up and get bigger and bigger until they seem like they're taking you over? And no matter what you do, if you look at them long enough, even when they're gone, you can still see them. Our goal today is to help you keep that from being a burden. 2012 tax brackets range from 10 to 35% on the federal level. State taxes can go from 0 to 11%. Sometimes, depending on where you live, you might have local taxes, county, township, city. And regardless of where you live, there is often the dreaded alternative minimum tax, sometimes called the silent tax because you don't see it coming. It is effectively an add-on tax for, quote, high-income taxpayers. And I say quote because in 1969, when this first came into being, it was designed to catch 155 high-income taxpayers who were taking advantage of all these deductions to the point where they paid nothing in taxes. And over time, because it wasn't adjusted for the changing times, in 2011, 4.3 million Americans paid AMT. Treasury doesn't mind this because it's a pretty good source of revenue for the government, even though many would argue at this point it's pretty unfair. There are supplemental taxes sometimes. The state of California, for instance, has a mental health tax on income over $1 million. An individual's marginal tax rate is the percent of tax that they pay on the last dollar earned. We differentiate this from the average tax bracket, which is your total tax divided by your total income. And if you're not careful and you settle a non-physical injury claim, you might find yourself in a position where you go from paying a modest tax rate into the highest bracket possible for 1 year only. You can avoid that. You don't have to do that. We don't want to see you paying any taxes you don't have to. And we can help you overcome this many times by analyzing your situation and planning in advance what the impact of your settlement is going to be on your tax position. Okay, here's our case study. This is actually a composite case. There was a high-profile case I worked on one time, had a confidential settlement, so I can't describe what I'd really like to. So I've changed the number of the facts, the number of the jurisdictions, so that it would never be identified. And I will give you this hypothetical case here where a woman is fired from her job in a casino for narking on one of her coworkers who she caught drinking on the job. Oddly, she was fired, not the coworker, but her spouse is a cab driver, and together they make a pretty decent living. They work hard, but they make a pretty decent living. They have for the past couple years hovered around $125,000, and they expect that will pretty much remain the same. She's working at another casino now and just waiting for her settlement. So her case finally goes to mediation. After attorney fees and costs, they successfully negotiate a settlement that is going to net her $250,000. It's now decision time for her. Should she take the cash or structure her recovery? If she comes to us, here's what we're going to do. We're going to go through a three-step process. First, we're going to analyze the tax liability and the impact of not just the cash settlement, but the impact of what happens if she structures it. We're going to see how much she can save in taxes if she arranges her affairs properly. And then we're going to go one step further and evaluate the cost of structuring by comparing what you would need to earn on your after-tax net if you took cash to equal the after-tax periodic payments and see whether or not it's a good deal. This is a spreadsheet we use. This is for a married filing jointly. We also have one for single taxpayers, and we've got 3 columns here. The first one shows their regular tax situation, how much money they make in a normal year. This second green box is reserved for their settlement that they're going to achieve through a taxable settlement, employment dispute, civil rights violation, whatever it is. And then the purple box is adds them both together. On the left-hand side, the regular gross income, you can see that taxes are tiered. So on the first $17,400, one pays 10% tax. That's reflected down here in the taxes that are due on that first piece of income. The second bit of income is taxed at 15%, and so on, all the way up to 35% in 2012. This does not take into consideration state taxes, by the way. We have a way of modifying that if you live in a state that has state taxes that would make this even a little bit more dramatic. So add this all together, and we see that in a regular year, this husband and wife will normally pay about 19% of their income in taxes. $23,310 total divided into 125 is 19%. But since they're in the 25% marginal tax bracket, the next dollar that they earn here is going to be taxed at 25%. And if it's a $250,000 settlement, it's going to take them into the 33%. If this was a $500,000 or higher, it would take them into the 35% tax bracket. But right now, average tax bracket of 19,000 or 19% rather, marginal tax bracket of 25%. Second slide now shows that we have used the same thing, only we have added the $250,000 taxable recovery. As we said before, this $250,000 is going to be paid at the 25, 28, and 33% tax rates, so that on that $250,000 they're paying over $77,000 in taxes. So instead of a 19% average tax bracket, they are in a 31% average tax bracket for their settlement recovery. That is a pretty dramatic spread. From 19 to 31, 12% difference in taxes. This 31%, I'm going to ask you to remember this for a minute. We'll show you how this comes into play, and then compare that to the 25% marginal bracket that they're already in. And then this purple column here again shows their total impact, their total marginal and average tax brackets. Let's take a look at what this looks like on a year-to-year basis. We said we started out with describing that this particular couple is pretty consistently at $125,000 in a very good living that they both make, but again, they work hard, put a lot of hours in, maybe don't see each other much, and they're comfortable with where they are in life. This lawsuit comes into play, and now they go for 1 year only all the way up to nearly $388,000 in taxable income in 2012. After they pay this 25% tax, this is how much they pay in 28% tax on, 33% here. If this were a higher settlement, they'd go into the 35% and above. So I want to ask you if it would be better to pay this tax all at once, or do as a lot of accountants suggest, spread your tax liability out into the future if you can. So what happens if we do that? We can take it so that the tax that is due normally was due here, we can spread that out over time and earn pre-tax interest along the way to help you take advantage of the tax deferral and minimizing the tax obligation. And we do it like this. instead of putting 250,000 in, we learned from before they were already in the 25% tax bracket, and they could still earn 17,700 in taxable income and still stay in the 25% bracket. So that's what we did here. We showed this in this 1 year, and we'll call this year 2012. They have their regular income. They used 17,700 of their 250 for a total income of 142,700 this year. And what's important about this, it keeps their taxes, even though they're paying 25% on that 17,700, it helps keep their average tax bracket at 19%. So they took as much as they could out of that 250 and still basically stayed where they were. Next, we go to a structured settlement quote. We take the $250,000 that the individual is being awarded, and we've already discovered that they want to receive 17,700 of that in the first year, so we pay that in cash. And then the balance, the 232,300, we put that into a structured settlement, and we want to try to see how many months we can pay out $1,475, which is $17,700 a year. Most people pay bills monthly, so monthly cash flow usually works better. And we discover that the cash flows can be paid out for 15 years and 8 months. So over that period of time, that 232,300 grows to $277,000. So we took their $250,000, instead of paying all the taxes on it this year, we've lowered their tax bracket this year and for 15 and 16 years into the future, and also earned an additional $45,000 in pre-tax income. But we're not done yet. So our final analysis is going to be to compare the structured settlement to what happens if they take the cash, pay the tax on it, and set the remainder aside. I have invest. It's not really an investment because we're comparing it to something on a secure, guaranteed basis that provides cash flow. And remember from our second slide, we know that the $250,000 is going to be taxed on average 31% compared to 25% in the future is what we're estimating. And we find structure over here, cash, earn interest, pay the taxes over here. You would have to earn 4.7% to equal this same cash flow. And I don't know about you, but my savings and checking account aren't earning me anything near this. So on this particular example, this is a perfect option for these folks. Add it all together, and it boils down to a choice between two things. Number one, paying all of your taxes in the year of settlement, in this case $77,000 approximately, or B, spreading your tax liability out over 16 years. And in this example, that liability results in paying $4,000 approximately fewer dollars. That doesn't even account for the present value of paying the money over time. So from a purely a tax perspective, clearly B is the better option. But in addition to that, you earn $45,000 in pre-tax interest. That amounts to 18% of your total recovery. You're making that on a pre-tax basis. Or another way to look at it is you're earning $2,800 a year on money you would have had to pay out. So by not structuring or by not paying tax all this year, you're earning $2,800 over time. If you've ever taken an accounting course or have an accountant or CPA yourself, you probably already know that deferring income and accelerating deductions are the foundation of proper, sensible tax planning. You want to achieve this any chance you get. And anytime I've ever talked with an accountant for a client who's going through this, they are almost universally in support of it unless the client has some immediate need for the money, which is often going to be the case, we realize. But if they can afford to do this, if they don't need that money, this is usually a very safe, very simple, very convenient way to maximize their recovery. Just a couple other things to think about. Payouts can begin whenever you choose. Now, the example we showed was a person who wanted to defer income into the next taxable year and have it paid out over 15 or 16 years. You could very just as easily had it deferred 10 years, 20 years, have some lump sums in the future. There's tons of flexibility here. It's just all going to depend on the needs of the individual. And it really often comes down to a choice, literally, between paying taxes and paying yourself. We've had some situations where some clients have deferred income over a very relatively short period of time, but because of their anticipated future tax positions, they don't really earn any money on the tax deferral, but they save so much on taxes that they do the deferrals anyway. And we realize that taxes don't always drive the entire financial decision-making bus, but when you can definitely save money by just waiting a little bit, you should think long and hard before giving money away. Otherwise, what could happen is you're taxed like a millionaire one year, and every other year you're taxed just like you were before, assuming you weren't a millionaire to begin with. And if you are a millionaire, then sometimes you can be taxed like less of a millionaire if you defer your income. Typically, the lower an individual's normal tax bracket, the higher the recovery, and the higher the recovery, the more valuable it is to structure. But again, don't assume this to be the case, because some very high net worth individuals have come to us and we've structured their either attorney fees or their recoveries, and they have been very pleasantly surprised at how valuable it is for them. We believe you can have it both ways, maybe just not all at once. If you remember at the beginning of the session, we had two pie charts that were side by side, and in this final pie chart comparison, the one on the left remains unchanged. The one on the right it might not look like it much, but it's slightly larger than the one on the left, and we're assuming that there are going to be multiple pies that are going to be paid out into the future, where you can keep the dark blue slice that's going out in taxes as small as possible, or at least as small as it was prior to the taxable settlement. There are some situations where we can even make it smaller than that, but each case is unique, and we really can't determine that until or unless you call. We have one final spreadsheet here that is blank because we have this reserved for you. If you are a practicing plaintiff attorney, defense attorney, business owner, claims professional, or an individual that's in the midst of discussion on some type of dispute that's going to result in taxable damages being paid, we invite you to call us and let us help you walk you through the comparison so you can see the impact of deferring your recovery. If you're a mediator, this can be helpful if you've got an offer and demand that are still pretty far apart. You can often bridge the gap with proper analysis here. If you have any questions on today's session, I invite you to either call, write, or email me. Would love to have a chance to talk with you about your own unique situation, confidentially, of course. And that will conclude today's session on taxable damages. I want to thank you again for checking in today. It's been a pleasure having the opportunity to talk with you. I invite you to call if I can be of any assistance at any time. And until then, I want to wish you all the best in your personal and professional lives going forward. Thank you very much.